Welcome back to the Rob Berger Show. We are continuing in this video our Morningstar User Guide series. This is video number 3. Recall, in the last video, we looked at some basic information that Morningstar shows us when we look at a mutual fund or an ETF. And you may recall that I skipped over something called the investment style box. And that's what we want to turn to today. And to do that, we're going to go back to the Vanguard S&P 500 Index Fund. Just as an example, we could use any fund. And recall how we find funds in Morningstar. There are different ways, but if you know the ticker, we can come up here to the ticker box, and this would be VF, I always forget this one, VFINX, I think. Yeah, there it is. And we can pull it up. And sure enough, there is our investment style box. And there's like a tic-tac-toe board, as you can see. It's got 3 rows and 3 columns, and in the top row, the middle column, it's filled in. So that tells us something, and we're going to talk today about what that tells us and why it's important. And I actually want to begin, at least at first, with the why it's important, and then we'll dive into what that exactly means and what it can tell us about a mutual fund. To understand why it's important, we have to turn to something called an asset allocation plan, which is really just a fancy way of saying an investment recipe. You think about making a meal, what do you need to know? Well, you need to know the ingredients and how much of each ingredient you need. And you can imagine going to the grocery store and not having a recipe and not knowing what you were even going to make that night. How would you know what to buy? Well, that's how I felt the very first time I started investing in 1992. It was with the law firm I had joined after law school. Their 401k was with Fidelity. And I got a long list of investment options. Actually, it looked a lot like this list right here that you're seeing on the screen. This is a list from Fidelity, and it's with my current 401k that happens to be through Forbes, where I'm an editor. And I still can vividly remember looking at a list like this. Of course, this was 1992, so it wasn't on a computer. It was in a pamphlet, I think, that the firm distributed to new employees. But I was just dumbfounded. I mean, I didn't know what most of these terms meant. Like here, a blended fund. I don't know what that was. Diversified. I mean, I can kind of understand it in concept. What's it mean here? What's INTL? What's IDX? All these terms here that you see. So I did what maybe many of you have done. I just said, forget the recipe. I didn't know anything about asset allocation. I just went over to the last column here of returns, and I picked the fund with the highest return. I mean, why not? And then I thought, well, maybe I should be more diverse than that. So then I picked like the top 3. So in this case, I would have picked the first fund, the third fund, and this one down here that's earned 16.25%. That seems like a pretty good deal. And I just threw some money in. Maybe not a bad way to start, at least as compared to doing nothing, but not exactly a thought out, thoughtful, planned approach to investing. And so beginning to understand how we categorize mutual funds and how we can use those categories to build a solid, sound, reasonable investment plan is kind of what this series is all about, using Morningstar data to help us. And so today, as we go back over to Morningstar, and we look at the investment style box, it's going to help us start to understand how mutual funds are categorized, and that will then in turn help us down the road build out a sound asset allocation plan. So back to the investment style box. We're going to look at it today as it relates to stock mutual funds, and then in the next video we're going to look at the investment style box as it relates to bond mutual funds, because they show you very different information. So today is stocks, and it's really pretty simple. Let's start with the 3 rows. There's a top row, a middle row, and a bottom row. And if the top row is colored in, it just means that the mutual fund invests in large companies, large public companies. Now, what do we mean by large? Well, first of all, what we mean is their valuation. So if you take all of the shares of a company, multiply it by its current stock price, what do you get? That's its value. And they call that market capitalization, or market cap for short, if you want to impress your friends at the next party, market cap. And they divide it between large, medium, and small. So you have large cap mutual funds, or stocks, mid cap, and small cap. Now you might say, well, how does Morningstar figure out what's large and what's medium and what's small? Well, you can dive into the details and actually get into the nitty-gritty of how they do it. The real key to know is that they grade on a curve. So they basically, for example, large cap, I believe they take the top 40% of total market cap and what companies fill in that top 40%, and that represents large. So it's not like a one set number. If you're over 500 billion in market cap, you're in a certain category. It's graded on a curve, but certainly we're all familiar with some of the larger companies. Think Apple, Microsoft, Amazon, companies that are worth hundreds and hundreds of billions. And in the case of Microsoft and Apple, for example, and I think Amazon too, their valuations, I think, are over $1 trillion at this point. I only hesitate because the stock market has been going crazy lately. So who knows what they are today versus yesterday versus tomorrow. But the point is, it divides the companies by market cap, large cap, mid cap, and small cap. And that's what those three rows do. Now, let me stop there and ask an important question. Who cares, right? I mean, why do we care as investors? Well, some of you might not care, but some of you do or should, and here's why. History tells us that the size of the company, or in this case, the companies that a mutual fund invests in, can determine both the returns of that fund over a long period of time, and also its volatility, how much it swings up and down. And so what we've seen over a really long time, think last 100 years, large cap companies have returned on average about 10%. Of course, some years are much more, some years are much less. It's an average. Small companies, though, have returned about 12%. Now, that's the good news. The bad news is small companies are much more volatile. They can go up a lot in one year, maybe even more than large companies. That's fine, but they can go down. And we can use that information down the road to construct an asset allocation plan. Now, we'll get into those details in later videos, but that's why the market cap is important. So again, the top row, large cap, the middle row, medium cap or mid cap, and the small one, or the bottom row is small cap. And you'll hear other terms. You'll hear micro cap, which would be really, really small. You may even hear giant cap, which would be, I guess bigger than large. But you get the idea. Once you understand the concept, all the terms start to make sense. So we can look at this fund and say, okay, Vanguard 500 Index fund, it's a large cap fund. We see that darkened square in the top row, and that makes sense because it's the 500 largest companies, more or less, in the U.S. All right, so what about the columns? Well, you have a column on the left, one in the middle, and one on the right. Well, the left column is companies that are described as value. We'll come back to that in a minute, but value companies. The right column would be companies that would be described as growth companies. We'll come back to what that means in a minute as well. And the middle column is called a blend. It's kind of a mix of the two. All right, so what does value on the left mean versus growth on the right? So value would be companies that are undervalued by some measure. So for example, a simple way to look at it would be, let's assume the market's average price to earnings ratio is 20 at the moment. And they define value based on PE. So you could imagine companies that have a much lower PE than, say, the market average. So they would be considered undervalued. You don't have to use PE or PE exclusively. Many formulas will look also at the price compare the price to the company's book value, their net worth, for example, and price to sales, and there are other measures. But basically, it's like you're getting something on sale. That's the idea of a value company. And a lot of value companies are the older companies. Some might even call them boring. They're typically the kind of companies I love to invest in. In today's environment, for example, big old stodgy banks would be value companies. On the other hand, growth companies are companies that are expected to grow their earnings, their revenue, their profit, their cash flow much faster than the average company. And those are the high flyers. Those are the companies that get all the press. They're the Teslas, and the Amazons of the world, growth companies. Now, you might say, well, which one is better? Are growth companies better to invest in, or are value? Well, it depends really what period of time you look at. I mean, over the last number of years here, growth companies have outperformed value companies. Some would argue that over long periods of time, value outperforms growth. And in fact, some folks will say, look, we can combine the market cap that we talked about a minute ago with the value versus growth and invest in a small cap value company mutual fund. And over time, some would argue that those types of funds perform better than average. Now, that doesn't mean you'd put all your money in a small cap value fund, but some would argue you should put about 10% in that fund. Again, we'll talk more about asset allocation in a later video, but now you understand the concept. If someone talks to you about a small cap value fund, you know what that is. It's a fund that invests in smaller companies, again, relative to public companies in general, and companies that are by some measure undervalued or on sale. And that's it. That's the style box. Now, we can look at the style box in a couple of different ways. And let me show you that on the screen. Here we're looking at it on the quote page. We're going to be talking about the portfolio tab in later videos, but there's something that I want to show you now related to this style box. Here it is again, much bigger. In fact, now they've taken the 3x3 box here and added a whole nother section to it around the outside, so they can show you that some companies are really big or really small or really growth oriented or really value oriented. And they even show you some other information. So for example, here, the blue is the Vanguard 500 index fund, and if we hover over it, it'll highlight it. And the circle, well, it's not really a circle, an ellipse, I guess, tilted one way. That shows you where all of the companies in this fund fall. The dot in the middle would be the weighted average. And so you can kind of get a better glimpse of where all of the companies in that fund fall. They also show you the category large blend. This is a category that Morningstar comes up with. It's pretty close to the Vanguard 500. And then they show you, for reasons, frankly, I don't even know why, but they decide to show you the Russell 1000, which of course is 1,000 companies. And it's a little bit smaller. It's not much. The average is just a little bit below the Vanguard 500 fund, but the outer ring is lower as well. It dips more into the mid-cap companies. And that's to be expected because it invests in not just the top or largest 500 companies, but roughly the largest 1,000 companies. Now, they give you a couple of other ways to look at this box. We can look at weight, which is kind of interesting. What this does is it divides up by these 9 boxes, roughly what percentage of the fund falls into each category. Now, what I found is that if you actually take the time to add up all those numbers, they don't always equal 100. And there can be different reasons for that. There's some money in cash, although this fund doesn't have a lot of it. And there is some fixed income in some funds. Here, for some reason, the fund has a very small amount of non-US equity. So they don't always add up to 100, but it gives you a rough idea of what percentage of the fund is in each different sector. So you can see the value to growth distribution, including some in the middle, pretty even. But you notice that there's 10% of this fund that's in mid-cap. And if you're wanting some exposure beyond just large companies, well, it turns out the Vanguard 500 index fund will give you that. But you'll notice it won't give you any exposure to small companies. And if that's something that you want in addition to the S&P 500, you'll either need to add another mutual fund to your portfolio, right? Another ingredient. Or you might be able to find a fund that could cover all of this plus this, all in one fund. How would we do that? Well, one idea, let me pull it up quickly. I'm doing this on the fly, so I'll confess I don't remember the ticker, but it's the Vanguard Total Market. I think it is this, no, it's the ETF. Well, I don't really want the ETF. Let's see here. It might be this one. Here we, oh, that's right, VTSAX. I own this fund, so you think I would remember the ticker. If they had tickers that were numbers, I would remember them. Anyway, we can see here, it's the same top middle box that's colored in. And so if we were to compare, let me actually move this side by side. Comparing these side by side at the quote level, there's no difference, right? U.S. fund, large blend for the total stock market. Same thing for the S&P. Same box colored in for the investment style box. But when we go to portfolio, we will see a difference. And here, the difference doesn't look huge. I mean, here, this is the S&P 500. Again, the dot's actually just outside of the tic-tac-toe box. And with the total stock market, it's just under it. And it's like, well, is that, it's a little bit of a difference, but is it a big difference? Well, this is where the weight view comes in handy. Remember, the S&P 500 doesn't have any small cap, but if we go over the total stock market, well, it does. It's got not a huge amount, but 5% in small cap. And the mid cap jumps from 10% for the S&P 500 index fund to 15% for the total stock market index fund. So if you were wanting some exposure to small cap and maybe a little more exposure to mid cap, but you didn't want to overcomplicate your portfolio, you could just invest in the Vanguard Total Stock Market Index Fund instead of the S&P 500 Index Fund. So this is how this information can help you actually make decisions, right? Now, I will just show you the historical tab, and all it does is show you if there's been any changes over time. This goes back a number of years, 5 years, I guess. With an index fund like this, it tracks the S&P 500, so it's pretty much always going to be a large blend. There's probably not going to be any changes to it. But if you invest in actively managed funds, which I've done in the past, not so much now, these styles can change. And often what I would find, for example, is I would invest in a value-oriented fund. But over time, particularly if the fund did well and its existing investments went up in value, it slowly shifted into a blend fund. And there were even cases where it went from value to blend and then blend to growth because the companies that the fund was investing in did so well and grew so much that, well, they became growth companies. So the history here can be important for some of you, again, depending on if you're investing in actively managed funds versus index funds. Now, I want to show you a couple more things before we bring the video to a close. The first is on the home page. I don't know if you noticed this when I started recording this video, but you see this same style box right here on the home page, and it's got all kinds of colors and positive and negative numbers, and it's got U.S. Barometer. What's all this about? Well, it's the same concept. You can see the rows are large, mid, and small, large cap, mid cap, small cap, and the columns are value. They call it core, but blend, same thing, and growth. And what this is showing you is how each of these sectors are performing today, right now, as I record this video on, I don't know what day it is, May 14th. The market is open. You can actually see here how it's performing. And what this is telling you is that value is doing okay today. Larger companies generally okay. Growth not quite as well. And small cap growth is down the most. Now, I think for most of us, certainly long-term investors, I can tell you I'm not focused on this U.S. Barometer box every day. In fact, I almost never look at it. But I'm pointing it out because once you understand the core concepts, and we've just scratched the surface, but once you understand them, interpreting information like this so that you can decide whether it's important or not is really easy and very quick. So I hope that helps you. Now, one more thing. I want to go back to my list of investments at Fidelity. And I want to sort of take what we've learned and apply it to an investment that I don't even know what it is. And it's this one right here that's just crushing it. And I'm thinking, well, what is this investment? And I don't know. I know it's a Fidelity investment. That's FID. OTC normally means over the counter. So this may be what it means. This is FOCKX. Got to be careful how I pronounce that one. Let's see what it is. FOCKX. There it is. Let's pull it up, take a look at it. So what do we learn? Again, applying what we've learned already. We see it's got 20 billion in assets. So I guess a pretty decent size fund. 79 basis points. I view that as high. Well, and so does Morningstar, as it turns out. There's no load. It's a U.S. fund, large growth. All right, we know what that means now. We see the colored box. We know it invests in large companies that are growth oriented, companies that are expected to grow their revenue, their earnings faster than most other companies. We also notice the yield. Remember, we talked about the trailing 12-month yield. In this case, I'm guessing these are all equities. We can look at that. Not much in way of yield. That kind of makes sense if we think about it, because the high-flying companies, right, Amazon, Google, Tesla, they're not paying a dividend. So it's not surprising that a company that's large cap growth fund wouldn't have a high yield, but its returns have been phenomenal. Of course, we know that because, and that makes sense, because growth companies have done extremely well, particularly in the tech sector. Now, again, I've never looked at this fund before. I'm doing this on the fly. So for all I know, it doesn't invest in Facebook and Google and whatever, Amazon. Well, let's find out. We go to the portfolio tab. It's mainly U.S. equities. We can see that right away. We can see, boy, it's huge companies. It's outside the tic-tac-toe board, and it's right on the edge of growth. So this is pretty serious. Let's see what it invests in. Well, Microsoft is number one, Apple, yep, Amazon, Alphabet, which is Google, Facebook, Alphabet. Yeah, not surprising, but here's the real key takeaway. Having just gone through 3 videos so far, all of this information should now be second nature to you. You understand what it is. In this case, you understand market capitalization, market cap, large cap, mid cap, small cap. You understand the difference between value and growth and kind of a way to think about it. And even in your own 401k, picking up an investment like this one here, FOCKX. No, I'm not going to pronounce that. And you know, in literally what, it took us 60 seconds, and boom, you know all about that fund. Oh, sure, there's more things we can learn, and in fact, we will as we move through the series. Now, in the next video, remember, we're going to be looking at the investment style box again, but we're going to be looking at it from a bond fund perspective. Hey, hope this video has been helpful. Remember, you can always reach me, rob@robberger.com. Please subscribe to the video if you enjoy this kind of information and it's helpful to you. And until next time, remember, the best thing money can buy is financial freedom.